Hello everyone. We of course all remember that April began with the US tariff announcements, provoking a high volatility and a fall in new bond issues. So, how did May start? April's shock is beginning to be absorbed, and while the direction is still unclear, the primary market has taken off again, allowing us to identify a number of key factors. For a start, Alphabet, Google's parent company, made a comeback after 5 years of absence. The American giant did not repeat the sustainable format, no comment on that, but it did issue colossal amounts. On May 1st, it issued $12.7 billion of bonds with maturities ranging from 2030 to 2065. And the coupon levels are nothing like those of 2020. At that time, the 20-year issue costed Alphabet 1.9% per annum. And if we do a fast forward to 2025, they issued a new 10-year bond, half of the maturity, which is costing them 450%, more than the double. Alphabet's surprise was amplified a few days later when the company issued on the European bond market for the first time ever. 6.75 billion euros spread over 5 maturities from 2029 to 2054. Investors' appetite was high, with order books covering up to 6 times the supply. And by combining those two currencies, Alphabet financed itself at less than 4% for an average maturity of 18 years. It's a great deal, especially for a company that at the end of March had almost $96 billion in cash in its balance sheet. This is not an isolated example, as a growing number of US issuers such as Visa or Johnson & Johnson are choosing to finance themselves on the European market. With lower yields and robust demand, the European bond market is a prime location for globally active companies. And beyond the de-dollarization themes, the figure confirmed the attractiveness of the European bond market. So this is the first thing that the primary market is currently telling us. Then if we turn to the US, activity has also picked up, but the circumstances are different, as Apple and General Motors, for example, have paid the price. Uncertainty over tariffs, announcement of planned production cost increase at Apple, and the absence of any result guidance for General Motors did not make their issue seamless. Don't worry though, they were easily placed, but both companies had to offer higher yields compared with their existing debt. Concession premiums were above the market average in 2025, and coverage ratios were comfortable but well below the market average this year. So another thing that the primary market tells us is that when supply chains of companies are mainly located outside the US, their new bonds are a little less welcomed. And finally, immune at this stage to the tariff war effect, US government debt regained some color. The latest 10-year auction benefited from a solid demand, which supported the global treasury market. So these various illustrations reveal a timid return of confidence. However, it will remain fragile for as long as tariff uncertainties persist and their economic impacts remain unclear. Thank you.